Reason number 3. The longer you leave your pension invested, the larger it should grow, enabling you to draw even more tax-free cash in the future. However, there is a lump sum allowance that limits the amount of tax-free cash that you can draw over your lifetime to £268,275. So once your pension has grown above £1,073,100, any further growth won't increase the amount of tax-free cash you can draw. Once you're past retirement age, your remaining tax-free cash, so the tax-free part of your pension, and an ISA have almost identical benefits. Money within them can grow free of income and capital gains tax, and you don't have to pay any tax when you take money out of them. However, unlike tax-free cash, there is no limit on how large your ISAs can grow, which means that you could take tax-free cash from your pension and put it into an ISA, invest it in exactly the same thing, and it could keep growing. This is a tactic that we often use with clients who are at or likely to hit the lump sum allowance at some point in the future. But before you do this, there's a few things you need to be mindful of. Firstly, due to the £20,000 annual ISA allowance, you may need to do this gradually over a number of years. Secondly, if you're concerned about inheritance tax, this might not be such a good option, because if you were to die today, any money inside of your pension falls outside of your estate, so no inheritance tax would be due on it. But if you take it out of your pension and put it into an ISA, it may be liable for inheritance tax. This added benefit of a pension means that it typically does not make sense to use tax-free cash to sub an ISA if you're in any way concerned about IHT. However, from April 2027, this benefit is being removed and pensions will form part of your estate.